You are giving yourself time to ride out market volatility without worrying about daily price fluctuations. This aligns perfectly with Buffett's philosophy of long-term investing, where the goal is not to make quick profits but to allow the investment to grow and compound over time. Real-world examples of the margin of safety in action. Let's take a look at a few examples where the margin of safety played a critical role in Buffett's investment decisions. 1. Coca-Cola. One of Buffett's most famous investments is his purchase of Coca-Cola in 1988. At the time, Coca-Cola's stock was trading at a price lower than its intrinsic value, and Buffett saw a significant margin of safety. Despite the company facing challenges in the market, Buffett recognized the brand's global dominance, strong cash flow, and potential for growth. By purchasing Coca-Cola at a discounted price, Buffett was able to benefit from the company's long-term success as the stock price eventually rose to reflect its true value. 2. Geico. Another example is Buffett's investment in Geico, the car insurance company. In the 1970s, when Buffett first bought Geico, the company was facing financial difficulties, and its stock price was undervalued. However, Buffett understood the company's business model, its potential for growth, and the competitive advantages it held in the insurance industry. By purchasing Geico at a discount to its intrinsic value, Buffett was able to benefit from its eventual turnaround and success. These examples demonstrate how the margin of safety allows investors to buy into companies that may be temporarily undervalued by the market, yet possess significant long-term potential. By investing in these companies at a low price relative to their intrinsic value, Buffett created a margin of safety that protected him from potential losses while positioning him to benefit from the company's future growth. How the margin of safety protects against market irrationality. The margin of safety also acts as a defense against the irrational behavior of the market. The stock market is often driven by emotions, fear, greed, and uncertainty, which can cause stock prices to fluctuate wildly in the short term. When a company's stock price is irrationally low due to market overreactions or negative sentiment, the margin of safety provides a way to buy when others are fearful, thus capitalizing on opportunities that others might overlook. Buffett has famously said, "Be fearful when others are greedy and greedy when others are fearful." This mindset is directly tied to the concept of the margin of safety. When the market overreacts and prices fall too far, it presents an opportunity for Buffett to step in and buy undervalued stocks. By purchasing these stocks with a margin of safety, he is able to protect himself from the market's irrationality and position himself for long-term gains when the market corrects itself. The importance of discipline in using the margin of safety. While the concept of the margin of safety may seem straightforward, its application requires discipline. The key to successfully using the margin of safety is being patient and waiting for the right opportunities. It's about resisting the temptation to chase after the latest trend or rush into a stock that seems appealing in the short term. Buffett has often emphasized that investing is not about being active every day or trying to make quick trades. It's about being disciplined, doing your homework, and waiting for opportunities where you can buy stocks at a price significantly below their intrinsic value. This requires a level of patience that many investors lack, but it's one of the key reasons Buffett has been able to generate exceptional returns over his career. Conclusion: the margin of safety as a pillar of Buffett's success. The margin of safety is one of the most powerful tools in Warren Buffett's investment arsenal. By buying stocks at a discount to their intrinsic value, he reduces risk, increases the potential for long-term gains, and protects himself from the inevitable ups and downs of the market. The principle of the margin of safety is a reflection of Buffett's broader philosophy, one that values discipline, patience, and a long-term perspective over short-term speculation. It is a core principle that has guided his investments for decades and continues to be a key part of his success today. In the next parts of this documentary, we will dive deeper into other core concepts of Buffett's investment philosophy, including his focus on economic moats and the importance of quality businesses. But for now, remember that successful investing isn't about taking unnecessary risks, it's about understanding the true value of a company and buying it at a price that gives you room for error and the opportunity to reap the rewards of long-term growth. Economic moats, the secret to Buffett's success. In the world of investing, it's not enough to simply find a stock that is undervalued. For Warren Buffett, the true key to long-term success lies in investing in companies that have a durable competitive advantage, something that will protect them from competition and allow them to thrive over time. This concept, known as the economic moat, is a cornerstone of Buffett's investment philosophy. But what exactly is an economic moat, and why does Buffett place such a high value on it when making investment decisions? What is an economic moat? The term economic moat was first coined by Buffett himself, inspired by the moats surrounding medieval castles. Just as a moat protects a castle from invaders, an economic moat protects a business from competitors, allowing it to maintain its competitive position and sustain profitability over time. In the world of investing, a company with a strong economic moat is one that has a unique advantage that its competitors cannot easily replicate or overcome. Buffett has often emphasized that the most successful businesses are those that have built strong moats around their operations, companies that are so dominant in their industry that they can continue to grow and generate profits regardless of the competition. The stronger the moat, the more resilient the company will be in the face of economic downturns, industry changes, or new competitors entering the market. Types of economic moats. There are several types of economic moats that Buffett looks for when evaluating potential investments. These include brand strength. One of the most powerful types of economic moats is brand strength. A strong brand is a company's ability to create customer loyalty and demand for its products, often regardless of price. Companies with well-known and trusted brands have a significant advantage because customers are willing to pay a premium for their products. This loyalty is hard to replicate, and it provides a long-term competitive edge. Buffett's investment in Coca-Cola is a perfect example of a company with a powerful brand moat. Coca-Cola's brand is recognized around the world, and consumers trust it to deliver a consistent, high-quality product. This brand strength has allowed Coca-Cola to maintain its dominance in the beverage industry for decades, even in the face of intense competition. Cost advantages. A company with a cost advantage has a moat in the form of lower costs than its competitors. This allows the company to offer its products at a lower price, while still maintaining healthy profit margins. Companies with cost advantages can weather economic downturns more easily, as they can continue to generate profits even when demand weakens. For example, Walmart has a cost advantage because of its massive scale and efficient supply chain. The company's ability to negotiate lower prices with suppliers and pass those savings on to customers has made it a dominant player in the retail industry. This cost advantage has been a key factor in Walmart's long-term success. Network effects. Network effects occur when the value of a product or service increases as more people use it. Companies that benefit from network effects can create a virtuous cycle. As more users join the platform, the product or service becomes more valuable, which attracts even more users, thereby strengthening the company's market position. One of the most prominent examples of a company with strong network effects is Facebook. As more people join Facebook, the platform becomes more valuable to each user, making it increasingly difficult for competitors to challenge its dominance. Similarly, Visa and MasterCard benefit from network effects. As the more merchants and customers use their payment networks, the more valuable the service becomes for everyone involved. Regulatory advantages. Some companies benefit from regulatory advantages, which can create barriers to entry for competitors. These advantages often arise from government regulations or licensing requirements that make it difficult for new companies to enter the market or compete at scale. Utilities are a prime example of companies with regulatory advantages. These companies often operate in regulated markets, where they are granted exclusive rights to provide services in a particular geographic area. As a result, they face limited competition and can generate stable, predictable cash flows. Switching costs. Switching costs are the costs that customers incur when they switch from one product or service to another. High switching costs can create a moat by making it difficult for customers to move to a competitor's offering. Companies with high switching costs can retain customers and generate more consistent revenue over time. For example, Microsoft benefits from high switching costs with its software products, such as Windows and Office. Once a customer has invested time and money into learning and using these products, they are less likely to switch to a competitor's offerings due to the cost and inconvenience involved. The importance of economic moats in value investing. For Buffett, investing in companies with strong economic moats is one of the keys to successful value investing. These companies are more likely to generate consistent profits and withstand the test of time. When evaluating potential investments, Buffett looks for businesses that have built a solid moat around their operations, making it difficult for competitors to take market share or erode profits. A strong economic moat not only provides a company with a competitive advantage but also gives it the ability to sustain high profit margins and generate reliable cash flow. These characteristics are essential for long-term wealth creation, as they allow companies to reinvest in their businesses, fund growth opportunities, and reward shareholders with consistent returns. Buffett's preference for companies with strong economic moats reflects his broader investment philosophy. He believes in buying businesses that have a long runway for growth and the ability to continue thriving, even in the face of competition and changing market conditions. By focusing on businesses with durable competitive advantages, Buffett has been able to build a portfolio of high-quality companies that can deliver reliable performance over the long term. How Buffett identifies companies with strong economic moats. Buffett doesn't just look at financial statements or stock prices when evaluating a company. He digs deep into the business to understand its competitive position and the strength of its economic moat. This requires a thorough understanding of the company's industry, its business model, and its long-term prospects. For example, when evaluating a potential investment, Buffett might ask himself several key questions. Does the company have a strong brand or customer loyalty? Does the company have cost advantages that allow it to compete effectively? Are there network effects that make the company's products more valuable as more people use them? Does the company have regulatory advantages that protect it from competition? Are there high switching costs that keep customers from leaving? If the answers to these questions are positive, then Buffett sees that as a sign of a strong economic moat. It's this focus on competitive advantage that has allowed him to make successful investments in companies like Coca-Cola, American Express, and See's Candies, businesses that have strong economic moats and are capable of generating consistent returns for decades. Conclusion: the power of a strong economic moat. In the world of investing, having a strong economic moat is one of the most powerful tools a company can possess. For Warren Buffett, investing in businesses with durable competitive advantages has been a key driver of his long-term success. By focusing on companies that have built strong moats around their operations, Buffett has been able to generate consistent returns and protect his investments from the volatility of the market. When you invest in companies with strong economic moats, you are essentially buying into businesses that are well-positioned to thrive for years, if not decades. This gives you the confidence to hold on to your investments through market fluctuations, knowing that the company's competitive advantage will continue to generate value over the long term. In the next parts of this documentary, we will explore how Buffett applies his philosophy of investing in companies with strong moats and how this has contributed to his track record of success. The long-term perspective: investing for generational wealth. Warren Buffett is often praised for his ability to see through short-term market noise and focus on the long-term picture. This long-term perspective is not just a hallmark of his investment strategy, it's a cornerstone of his success. While many investors are preoccupied with quarterly earnings, short-term stock movements, and market trends, Buffett takes a completely different approach. He buys businesses with the intention of holding them forever. This philosophy has led to his success, and it's one of the reasons why his investments have performed so well over time. In this part of the documentary, we'll explore the importance of adopting a long-term perspective when it comes to investing. Buffett's approach isn't about chasing quick profits or trying to time the market. It's about choosing high-quality businesses that can continue to grow and compound wealth over time, regardless of short-term fluctuations. The power of compounding. At the heart of Buffett's long-term perspective is his belief in the power of compounding. Compounding is the process by which an investment grows exponentially over time. It occurs when the returns generated by an investment are reinvested, allowing the investment to earn returns on both the initial principal and the accumulated returns. Buffett famously said, "My wealth has come from a combination of living in America, some lucky genes, and the ability to compound my investments." The key to his success lies in allowing his investments to grow and compound over decades, rather than trying to make quick trades or chasing short-term market trends. This approach requires an immense amount of patience. Many investors are focused on short-term gains, looking for quick profits by buying low and selling high. But Buffett's method is fundamentally different. He believes that the real wealth is created by holding on to quality companies for the long haul and allowing their intrinsic value to compound over time. Buffett often speaks about how his wealth is the result of his ability to remain patient and allow compounding to work its magic. He has said that if you can hold on to great companies for 20, 30, or even 50 years, the returns will grow significantly. And the best part? The longer you hold on to these businesses, the more powerful the compounding effect becomes, patience over short-term speculation. While many investors are caught up in the excitement of day trading or reacting to daily market fluctuations, Buffett stands firm in his belief that investing is not a game of short-term speculation. He has often said that his favorite holding period is forever. For him, the key to successful investing is to identify high-quality businesses with strong management, economic moats, and the potential for long-term growth, and then to hold on to them, no matter what the market does in the short term. This long-term approach allows Buffett to ignore the daily noise of the stock market. The stock market is notoriously volatile, with prices rising and falling due to factors that have little to do with the underlying fundamentals of a business. Many investors make the mistake of reacting to these short-term fluctuations, selling off stocks during periods of volatility or buying into the hype during market booms. This is where Buffett's approach differs. He doesn't concern himself with short-term market movements because he knows that, over time, the true value of a business will be reflected in its stock price. Buffett's ability to ignore the short-term noise and focus on long-term value is a critical factor in his success. For example, when the dot-com bubble burst in the early 2000s, many investors panicked and sold off their stocks. But Buffett saw this as an opportunity to buy high-quality companies at discounted prices. By sticking to his long-term strategy, he was able to capitalize on these opportunities, and those investments paid off handsomely in the years that followed. The importance of quality businesses. Buffett's long-term perspective is tied directly to his focus on quality businesses. While other investors may jump in and out of stocks based on short-term trends, Buffett looks for companies that can grow and thrive over decades. This focus on quality ensures that even when market conditions are unfavorable, the company's fundamentals will remain strong enough to weather the storm. Buffett has always emphasized the importance of investing in businesses that are easy to understand, companies with a clear and sustainable competitive advantage. He avoids investing in companies that are overly complex or operate in industries he doesn't fully understand. This focus on quality means that Buffett's investments are less likely to suffer from the market's erratic swings because the businesses he invests in have strong foundations and the ability to generate reliable cash flow over time. Take his investment in Coca-Cola, for example. When Buffett bought Coca-Cola in 1988, the company was already a global leader in the beverage industry. The stock was trading at a reasonable price relative to its intrinsic value, and the company had a powerful brand, a dominant market position, and the ability to generate consistent profits. By investing in a high-quality business with a long-term growth trajectory, Buffett positioned himself to benefit from Coca-Cola's success for decades. Buffett's investment in Berkshire Hathaway itself is another example of his long-term strategy. When Buffett took control of Berkshire Hathaway in the 1960s, he saw it as a vehicle for making long-term investments in high-quality businesses. Over the years, Buffett has used Berkshire Hathaway to acquire companies like Geico, Duracell, and See's Candies, all businesses that have strong competitive advantages and the ability to generate consistent profits. The benefit of staying the course. A crucial aspect of Buffett's long-term approach is his ability to stay the course, even when the market is volatile or when others are panicking. The stock market has experienced numerous crashes, recessions, and periods of uncertainty throughout Buffett's career, yet he has always stuck to his disciplined, long-term strategy. Buffett has said that the stock market is like a voting machine in the short term but a weighing machine in the long term. In the short term, stock prices are often influenced by emotions and speculation. Investors react to news, rumors, and short-term events, causing stock prices to fluctuate wildly. However, in the long run, the true value of a company will always shine through, and its stock price will reflect its underlying fundamentals. This mindset has allowed Buffett to weather the market's ups and downs with remarkable success. During the 2008 financial crisis, for example, many investors sold off their stocks in fear of further market losses. But Buffett saw the market's turmoil as an opportunity to buy high-quality companies at a discount. He famously made significant investments in companies like Goldman Sachs and General Electric during the crisis, which later turned out to be highly profitable decisions. The role of long-term thinking in wealth creation. Warren Buffett's long-term perspective has played a significant role in his ability to create generational wealth. By buying great companies and holding onto them for decades, Buffett has been able to build a portfolio that has generated billions of dollars in returns. The power of compounding, combined with his focus on quality businesses and his discipline in ignoring short-term fluctuations, has allowed him to amass an extraordinary fortune over time. Buffett's success serves as a reminder that building wealth through investing is not about making quick, speculative moves. It's about finding high-quality businesses that are undervalued, buying them with a margin of safety, and then holding onto them for the long term. By following this strategy, investors can allow the power of compounding to work in their favor, generating wealth over time and positioning themselves for long-term success. Conclusion: the virtue of patience. Warren Buffett's investment philosophy is a testament to the power of long-term thinking, patience, and discipline. His ability to stay focused on the fundamentals and ignore short-term market fluctuations has been a key driver of his success. By buying high-quality businesses, holding on to them for decades, and allowing the power of compounding to work its magic, Buffett has built a legacy of wealth that spans generations. For investors looking to emulate Buffett's success, the message is clear: focus on quality, be patient, and think long-term. Wealth creation through investing is a marathon, not a sprint. The power of consistency and staying true to your strategy. Warren Buffett's success as an investor is not just a result of his knowledge or his ability to pick winning stocks. One of the most important factors in his long-term success is his consistency and ability to stick to a clear investment strategy, even when the market is unpredictable, and others are jumping on the latest trends. While many investors are swayed by the noise of the market, the whims of speculation, or the rush of short-term excitement, Buffett's approach has always been centered around discipline and sticking to his principles. In this part of the documentary, we will explore the power of consistency and how Buffett's ability to stay true to his value investing strategy has played a crucial role in his remarkable success. It's not just about picking good investments, it's about consistently applying the same set of principles year after year, regardless of market conditions. The importance of a well-defined strategy. One of Buffett's key principles is having a well-defined investment strategy and sticking to it. Buffett's strategy is grounded in value investing. He seeks to buy stocks in companies that are undervalued relative to their intrinsic value. While many investors are constantly chasing after the next big thing or reacting to market fads, Buffett remains focused on his core philosophy: buy good companies at a reasonable price and hold them for the long term. This strategy doesn't change based on market conditions. Whether the market is booming or in a downturn, Buffett stays committed to his principles. For example, when the dot-com bubble burst in the early 2000s, many investors were quick to abandon traditional value investing in favor of high-growth tech stocks. Yet Buffett stuck to his guns, resisting the temptation to buy into the hype. Instead, he continued to focus on well-established companies with strong competitive advantages and long-term potential. His consistency is key to his success. By staying true to his approach, Buffett has built a track record that few can match. His ability to stay focused and avoid the temptation to jump into speculative investments has been one of the cornerstones of his investment strategy. It's not just about picking good investments, it's about having the discipline to follow a strategy and not be swayed by temporary market trends, the power of patience and discipline. In addition to consistency, patience and discipline are crucial components of Buffett's investment strategy. While many investors chase quick returns and get caught up in the hype of short-term market movements, Buffett has always maintained a long-term outlook. He is willing to wait for the right opportunities and doesn't try to force trades or make moves based on market noise. This discipline is especially evident when you consider Buffett's focus on buying companies with strong economic moats, solid financials, and predictable earnings. He doesn't get distracted by the ups and downs of the market. Instead, he waits for the right moment when a company is undervalued, often during periods of fear or market pessimism, and then buys with a margin of safety. Buffett's famous quote, "The stock market is a device for transferring money from the impatient to the patient," perfectly encapsulates his approach. By remaining patient and waiting for the right opportunities, Buffett allows compounding to work its magic over time. While others are often looking for quick profits, Buffett understands that the true rewards of investing come from staying the course and allowing time to reveal the true value of an investment. Why most investors fail and how Buffett avoids it. One of the reasons most investors fail is because they are constantly chasing after short-term gains. They may get caught up in the excitement of a hot stock or a market trend, only to lose money when the bubble bursts or the hype dies down. Buffett has seen this cycle repeat itself throughout his career. He famously said, "The stock market is filled with individuals who know the price of everything, but the value of nothing." This highlights the fact that many investors are more concerned with short-term price movements than the intrinsic value of the companies they invest in. Buffett, on the other hand, focuses on understanding the true value of a business, regardless of its stock price. He then waits for the right moment to buy, when the stock is undervalued relative to its intrinsic worth. This consistent focus on value over short-term fluctuations allows Buffett to avoid the mistakes that most investors make. While others panic during market downturns, Buffett sees these periods as opportunities to buy quality companies at a discount. His consistent strategy of buying undervalued businesses and holding them for the long term has enabled him to avoid the volatility and mistakes that often plague other investors, the role of knowledge and research in consistency. Another aspect of Buffett's consistency is the immense amount of knowledge and research he invests in before making any decision. While many investors base their decisions on market trends, tips, or rumors, Buffett does extensive research on the businesses he's considering. He has said that his investment decisions are based on his understanding of the business and its future prospects. Buffett's knowledge isn't just about reading financial reports, he immerses himself in the company's operations, culture, and management. He often spends hours or even days reading about the business, its industry, and its competitors before making any decisions. This level of due diligence allows him to confidently make long-term investments in companies he believes will succeed, even in the face of short-term volatility. In his famous letter to Berkshire Hathaway shareholders, Buffett has often emphasized the importance of being well-informed and thoroughly understanding what you're investing in. Risk comes from not knowing what you're doing, he has said. By consistently applying this principle of knowledge and research, Buffett avoids the mistakes that many investors make when they invest without fully understanding the business they're buying. The role of emotional control. Perhaps one of the most important factors in Buffett's consistent success is his emotional control. Investing is often an emotional journey. The highs of seeing your investments grow, the lows of market crashes, the fear during recessions, and the greed during bull markets, all of these emotions can cloud an investor's judgment and lead to poor decisions. Buffett, however, is known for his ability to maintain emotional discipline. He remains calm and rational during market fluctuations, never allowing his emotions to drive his decisions. He is famously quoted saying, "The most important quality for an investor is temperament, not intellect." This emotional control allows him to avoid making impulsive decisions during times of market volatility and to stick to his strategy even when others are panicking. By keeping his emotions in check, Buffett has been able to consistently make decisions that align with his long-term investment philosophy. While others may sell in fear or buy in greed, Buffett stays true to his values and remains focused on finding businesses that have intrinsic value and strong growth potential. Consistency and its role in building long-term wealth. In the end, Warren Buffett's consistency is the reason for his unparalleled success. By sticking to a clear, disciplined investment strategy over many decades, he has been able to build a fortune that has grown exponentially. His ability to stay true to his principles, regardless of market conditions, has allowed him to take advantage of opportunities that others miss and avoid the mistakes that most investors make. The takeaway for anyone looking to replicate Buffett's success is simple: consistency matters. By developing a sound investment strategy, staying disciplined, and focusing on long-term value, anyone can build wealth over time. It's not about getting rich quickly, it's about staying the course and letting time, knowledge, and discipline work in your favor. In the next parts of this documentary, we will delve deeper into how Buffett applies these principles to his investments, including his unique approach to managing risk, his process for choosing the right companies, and how his philosophy continues to guide his decisions today. But for now, remember that the key to Buffett's success lies not in flashy moves or speculative bets, but in his unwavering consistency and his dedication to staying true to his values. Managing risk: how Buffett avoids the pitfalls of speculation. One of the most critical aspects of Warren Buffett's success as an investor is his ability to manage risk. While many investors focus on maximizing returns, Buffett's approach has always been centered around minimizing risk. He often says, "The first rule of investing is don't lose money. The second rule is don't forget rule number 1." This simple yet powerful idea underscores the importance of protecting capital, and it's a principle that has guided Buffett's decisions throughout his career. In this part of the documentary, we will explore how Buffett approaches risk, why he considers risk management to be essential, and how his strategy differs from more speculative, high-risk approaches that focus on short-term gains. We will also discuss how his focus on minimizing risk has allowed him to weather market volatility and emerge as one of the most successful investors in history. Understanding risk: the Buffett perspective. For most investors, risk is often associated with volatility, the daily ups and downs of stock prices. However, Buffett sees risk in a different light. For him, risk is not about price fluctuations but about losing money, specifically, the risk of permanent loss of capital. He has repeatedly stressed that it's far more important to preserve capital than to try to make quick, speculative gains. Buffett's philosophy on risk is grounded in the idea that the real danger in investing isn't volatility, it's the possibility of making an investment that will lose its value permanently. While markets may experience short-term price swings, a good investment, one that is undervalued relative to its intrinsic worth, should continue to hold its value over the long term. This is why Buffett places such a strong emphasis on buying companies with strong fundamentals, economic moats, and a margin of safety. These factors help mitigate the risk of permanent capital loss. The margin of safety: a buffer against risk. A core concept in Buffett's risk management strategy is the margin of safety, a cushion that helps protect an investor from unexpected losses. The margin of safety is the difference between the price an investor pays for a stock and its intrinsic value. By purchasing a stock at a significant discount to its intrinsic value, an investor reduces the risk of overpaying for an asset that could decline in value. For example, if Buffett buys a company's stock when it is priced below its intrinsic value, the margin of safety provides protection if the company's performance doesn't meet expectations or if unforeseen market conditions cause a decline in price. The larger the margin of safety, the less risk there is for the investor. Buffett believes that buying stocks with a substantial margin of safety ensures that even if the market turns against you in the short term, the value of the business will still likely be realized over the long term. By focusing on undervalued stocks with strong economic moats and reliable management, Buffett minimizes the risk of making a poor investment decision that could lead to permanent capital loss. Avoiding speculation: the key difference between investing and gambling. While many investors focus on speculation, betting on the short-term price movements of stocks, Buffett has always emphasized that investing is not about speculation. Speculation involves making predictions about the future price movements of a stock, often based on trends or market sentiment. Investors who engage in speculation are essentially gambling, hoping for short-term price movements that will lead to profits. Buffett's approach, on the other hand, is grounded in fundamentals. He seeks to buy shares of companies that are undervalued based on their intrinsic worth. For Buffett, investing means buying a business, not just a stock. He wants to own companies with strong competitive advantages, capable management, and a history of reliable performance. He looks for businesses that can continue to grow and generate cash flow over time, even during periods of market volatility. Buffett has said, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes." This long-term mindset is a key part of his risk management strategy. Rather than focusing on the short-term price swings, Buffett focuses on the long-term growth prospects of the businesses he buys, ensuring that his investments are based on real value and not speculative guesses about where the stock price will go next. Risk and management, the role of strong leadership. Buffett also places a strong emphasis on management quality when evaluating risk. He believes that one of the best ways to mitigate risk is by investing in companies with capable and trustworthy management teams. A company's leadership is crucial in navigating difficult market conditions, managing risks, and making the strategic decisions necessary for long-term growth. Buffett often says that he looks for managers who are honest, competent, and shareholders-oriented, leaders who treat the business as if it were their own money at stake. He believes that great companies are led by great people who understand how to allocate capital wisely, manage risk, and make decisions that benefit the company and its shareholders over time. For instance, his investment in Geico was largely based on the strong leadership of its management team. The company had a well-established track record of success, and its management demonstrated an exceptional ability to manage risk and drive growth, making it a compelling investment opportunity. By placing his trust in capable management, Buffett was able to reduce the risk of making a poor investment and increase the likelihood of long-term success. Diversification versus concentration, how Buffett views risk. One common piece of advice given to investors is to diversify, spread investments across a wide range of assets to reduce risk. While diversification may help protect against risk in some cases, Buffett has a different view. He believes that concentration, investing in a smaller number of high-quality companies, is a more effective way to manage risk. Buffett has famously said, "Diversification is protection against ignorance." It makes very little sense if you know what you are doing. He argues that if you truly understand the businesses you're investing in, and if you've done your homework thoroughly, then there is no need to over-diversify. Instead, concentrate your investments in the few businesses that you truly understand and believe in. By focusing on quality over quantity, you increase the chance of success and reduce the risk of spreading yourself too thin. For example, at Berkshire Hathaway, Buffett has made significant investments in a relatively small number of companies, such as Coca-Cola, American Express, and Apple. While these investments represent a concentrated portfolio, they are backed by strong businesses with economic moats, capable management, and long-term growth potential. This approach has allowed Buffett to manage risk while maximizing returns. The role of patience in risk management. Patience is an often overlooked aspect of risk management. Many investors feel pressured to act quickly, whether it's to buy a stock they believe is undervalued or to sell one when the market seems unfavorable. But Buffett's approach is different. He is willing to wait for the right opportunities, even if it means sitting on cash for extended periods. Buffett's patience allows him to avoid unnecessary risks and take advantage of investment opportunities when they present themselves at the right price. He believes that good opportunities don't come every day, and the key to successful investing is being ready when the time is right. During market downturns, when fear and uncertainty are widespread, Buffett remains calm and patient, knowing that he can buy high-quality companies at discounted prices. By staying patient and waiting for the right opportunities, Buffett can avoid the temptation to make rash decisions that expose him to unnecessary risks. He understands that investing is a marathon, not a sprint, and that wealth is built over time by making thoughtful, well-researched decisions. Conclusion: risk management as the bedrock of Buffett's success. Warren Buffett's approach to risk management has been a fundamental part of his success as an investor. By focusing on minimizing the risk of permanent capital loss, Buffett has been able to navigate market volatility and come out ahead. His emphasis on the margin of safety, strong management, and investing in high-quality companies has allowed him to build a portfolio that has consistently generated wealth over the long term. Buffett's view of risk, focusing on preservation of capital rather than short-term volatility, sets him apart from many other investors who chase after high-risk, high-reward opportunities. By adhering to a disciplined, patient strategy, Buffett has avoided the pitfalls of speculation and positioned himself to succeed in the ever-changing world of investing. In the next parts of this documentary, we will dive deeper into some of Buffett's most iconic investments, examining how his risk management strategies played a role in his decision-making process. But for now, remember that successful investing is not about avoiding risk altogether, it's about managing it wisely and staying true to your principles, just as Warren Buffett has done throughout his legendary career.